Usually when you sit down to analyze whether a company is a good bet, there's this expectation of pure objective math.
Right. It feels incredibly safe.
Yeah, exactly. You pull up the spreadsheet, you punch in the revenue, the margins, the growth rate, and out pops a perfectly rational valuation. It feels scientific, you
Right.
know?
Absolutely. We really want the world of business and finance to be a strict physical science. Like, we like formulas because they give us the illusion of absolute certainty.
But then you realize that every single number in that beautiful, complex model it was put there by a human being.
Exactly.
And suddenly, that pristine spreadsheet isn't a math equation anymore. It's a psychological profile. For anyone tuning in, today's deep dive is really going to prove that the single most crucial metric in any business evaluation isn't revenue and it isn't profit margins. It is the completely invisible character of the founder.
Yes. And we are diving into a fascinating piece today from Equity Decoded by Spirit. It was actually just published today, June 2nd, 2026, and it's called The Spreadsheet Won't Save You: Why the Promoter is the Business.
Such a good title.
It really is. And it proves that treating a company's leader, the promoter, as they call it in the piece, as just another input on a spreadsheet is basically the easiest way to lose all your money.
Okay, let's unpack this. We build these massively complex models, like a discounted cash flow model, which, for anyone who hasn't built one, is essentially just a fancy way of guessing how much cash a business will make in the future and working backward to see what it's worth today.
Right, exactly.
But if the person handing you those starting numbers is a liar, your math is completely worthless.
If we connect this to the bigger picture, that is exactly what the article calls the spreadsheet trap. And it really starts with quantification bias.
Quantification bias. Okay, explain that.
Well, the financial industry rewards numbers. If you just say, hey, I trust this management team, you sound lazy, right? But if you say, this trades at 14 times forward earnings with a 22% return on capital, you sound incredibly rigorous.
Oh, for sure. You sound like you did the work.
But you're mistaking precision for accuracy. Building out a mathematical model to 2 decimal places for a business run by a chronic misallocator of capital isn't analysis, it's just financial theater.
Because you're assuming the numbers they gave you are ground truth, which, that leads right into a trap you see a lot, right? We look at a balance sheet like it's the laws of physics, completely forgetting that humans manufactured those numbers.
Precisely. That is survivorship bias in accounting. Every single number on a balance sheet is the output of hundreds of subjective judgment calls by management.
Like what?
Like, when do they actually recognize revenue? Or what cost do they capitalize as an asset versus expensing it right away? How do they report transactions with their own related side businesses?
Right.
So when you take those numbers at absolute face value, you are implicitly making a massive bet on management's integrity. And you're often completely blind to the fact that you're even making a bet.
And I imagine that trap snaps shut the hardest when the company has a really compelling story attached to it.
Oh, definitely. That's the final piece of the trap narrative seduction. The most dangerous promoters aren't running obviously terrible businesses. They are running highly plausible businesses wrapped in intoxicating stories.
Like AI or something.
Right, or digital payments, financial inclusion, electric vehicles. A good story acts as an anesthetic that basically just completely numbs your forensic instincts.
I love that phrasing. It's like reviewing a restaurant by only looking at the math of its supply chain while completely ignoring whether the head chef has a history of poisoning people.
That is exactly it.
You can have the most cost-efficient tomato delivery system in the world, but if the guy in the kitchen is fundamentally toxic, the restaurant is going to fail.
The chef dictates everything about the final dish, just as the promoter dictates every number on the sheet.
Now, theory is great, but let's see how this actually plays out. Show me the receipts. Let's look at historical examples where smart people, armed with all this math, completely missed the warning signs. Let's start with the boring red flags.
Let's look at Satyam Computer Services in 2009. On January 7th of that year, the promoter, Romalinga Raju, confessed to a massive fraud of roughly 7,000 crore rupees.
Wow.
Yeah. He called it riding a tiger, a fabrication that just kept growing until he literally couldn't get off.
The market completely tanked when that happened. But what's crazy to me isn't the confession itself, is that nobody saw it coming in the math. Where were the analysts?
Well, they were looking at the wrong math. In September 2008, Satyam reported cash and bank balances of 5,361 crore. Now, for an IT services giant, that sounds totally plausible. They generate a lot of free cash flow.
They're printing money.
But the glaring anomaly was the interest income. In that same year, they reported roughly 2.1 crore of interest income on that supposed massive pile of cash.
Wait, let me do that math. That implies a yield of about 0.04%.
Right?
0.04% in India. How does that even work?
It doesn't. At that time, overnight money market rates in India, basically the baseline interest you get just for parking cash in a safe bank, were hovering around 6 to 7%.
Oh, wow.
So you have a supposedly sophisticated tech giant generating a 0.04% return on billions of rupees. Either they invented a new anti-yielding bank account or the cash simply didn't exist.
And that red flag was just sitting right there in the annual report, visible to absolutely anyone with a basic calculator.
Yeah.
But wait, what about the auditors? Didn't PricewaterhouseCoopers certify those balance sheets year after year? And didn't Raju win a major corporate governance award right around that time?
He did. He won the Golden Peacock Award for Corporate Governance in 2008. And yes, PwC signed off on the accounts.
That is insane.
But it proves a critical point. An auditor provides a basic hygiene check, not a character assessment. Raju is speaking at Davos, sounding super visionary. But words are free. Capital allocation is expensive. You have to judge a promoter by where the money actually flows.
Right. Give me an example of that with Raju.
Well, just weeks before his confession, Raju tried to use Satyam's supposed cash to buy two infrastructure companies, Meta's Properties and Meta's Infrastructure, for 7,800 crore.
Hold on, let me guess. Meta's is Satyam spelled backward. Who owned those companies?
His own family.
Of course.
And the board approved this massive related party acquisition in a meeting that reportedly lasted less than an hour.
Under an hour for 7,800 crore.
Yep. They only reversed it when institutional shareholders revolted, and the stock crashed 55% in a day. That is the ultimate tell about governance. The money was being funneled directly into the family's pockets.
Okay, so that's Satyam, but that was 2009. I mean, we have to have gotten better at spotting this since then, right?
Unfortunately, no. Fast forward to Dewan Housing Finance Corporation, or DHFL, in 2019. They were the absolute darling of a housing finance sector. They were perfectly riding the narrative of affordable housing and financial inclusion.
Oh, everybody loves a good financial inclusion story.
Exactly. The stock was compounding at over 30% annually. But behind the scenes, the promoters were running a massive shadow operation.
How massive? And more importantly, how do you hide a shadow operation in a publicly traded financial company?
So when forensic auditors from Grant Thornton were finally brought in, they found a shadow loan book of over 29,000 crore.
29,000 crore.
Yes. The mechanics of it are actually fascinating. They created 87 paper companies, literally shell companies, that existed only in file cabinets with zero real operations.
Okay.
The DHFL would report that they made a giant legitimate loan to a property developer, which was actually one of their own shell companies. That shell company would then quietly funnel the cash right back to the promoter's personal accounts or their other private ventures. It was just a giant loop.
So they were essentially approving loans to themselves using shareholder money. But how did nobody notice that 29,000 crore was going out the door to nowhere? Was there a calculator test failure here, like with Satyam?
It was more of a failure of basic physical reality. If you look at DHFL's public numbers, their loan book was exploding. They were supposedly dispersing thousands of small-ticket affordable housing loans all across the country.
Right, but if you do that, you need massive physical infrastructure.
Exactly.
You need loan officers to evaluate properties. You need physical branches to process the paperwork and collect payments.
And that's the tell. DHFL's massive loan book growth completely decoupled from their physical operational capacity. Their branch count and employee headcount just didn't scale with their exploding assets.
Wow.
You literally can't originate that much retail volume with a headcount ratio that makes no physical sense. Somebody was manufacturing assets out of thin air, and the market ignored it because the top-line growth looked so good on a spreadsheet.
Here's where it gets really interesting. We just talked about boring math anomalies, like loan books that grow without employees. Let's pivot to that third trap you mentioned earlier, narrative seduction. Businesses that dazzled the market with a story so good, it basically acted as a narcotic.
Wirecard is the definitive example of this. It shows that even in the most tightly regulated markets, armed with top-tier auditors, a determined promoter can sustain a complete fiction if the story feeds what people want to believe.
Okay, lay it out for us.
Markus Braun built Wirecard into a German DAX 30 powerhouse, claiming 3 billion euros in revenue.
Wait, hold on. I get missing a bad loan, but how does a company fake billions in revenue in a highly regulated European market?
So the story was that obscure third-party partners in Southeast Asia were processing payments for them and holding the cash in trustee accounts. They claimed they had 1.9 billion euros sitting safely in two Philippine banks.
But checking bank balances is day one auditing. How does a promoter actually fake that? I mean, Ernst& Young was auditing them.
They faked it by forging letters from the banks. And they relied on the fact that auditors generally trust the documents handed to them by management, especially when those documents come from opaque third-party trustees in foreign jurisdictions.
That's bold.
Very. But the real reason they got away with it for so long was the narrative seduction. The German establishment desperately wanted a homegrown European financial technology champion to rival American giants like PayPal or Chinese giants like Alipay.
Ah, I see.
Yeah, it was emotionally satisfying to believe the hype.
Right.
It basically became a matter of national pride.
So the financial regulators, the people whose entire job is to protect investors, essentially acted as the promoters' bodyguards because they liked the story too much.
Honestly, they were worse than bodyguards. Investigative journalists at the Financial Times, specifically Dan McCrum, started publishing detailed evidence of accounting irregularities back in 2015.
Okay.
And how did the German regulator, BaFin, respond? They opened a criminal investigation into the journalists.
Are you kidding me?
I wish. They actually banned short sellers from trading Wirecard stock to protect the company. SoftBank threw another 900 million euros at them. Ernst & Young just kept signing off on the accounts until 2020.
Unbelievable.
And 2020 is when the Philippine banks finally confirmed in writing that the accounts were totally fabricated.
So they literally went after the people pointing out the fire instead of investigating the smoke. That is wild. Let's bring this closer to the present, though. The Substack article mentions BlueSmart Mobility's collapse in early 2025.
Yes, BlueSmart is a textbook case of narrative as a narcotic. They entered the Indian market promising an all-electric, ESG-compliant ride-hailing fleet to take on Ola and Uber.
Right, the EV narrative was incredibly intoxicating.
Oh, totally. The government was handing out massive FAME subsidies, financial incentives for electric vehicles, and impact investors were desperate to throw money at anything green. By 2024, they claimed to be operating over 7,000 EVs.
So what was the mechanism underneath the green veneer? How were they extracting value?
The core issue was a listed entity called Gensol Engineering, which was controlled by the exact same promoters. Gensol acted as BlueSmart's vehicle procurement arm and financier.
Okay, I follow.
Gensol would raise massive amounts of debt to buy electric vehicles, lease those vehicles to BlueSmart, and book the revenue. Then, BlueSmart would use the vehicles and pay lease fees back to Gensol to service the debt.
Hold on, I want to push back on this for a second. If a founder owns multiple companies in the same vertical, aren't related party transactions somewhat normal? Like, wouldn't it make sense to use your own supply chain rather than paying a middleman?
On the surface, yes. But there is a massive difference between operational synergy and a closed loop designed for extraction.
Explain the difference.
In a normal business, the open market dictates the price of a lease.
Oh.
But when the promoter controls both sides of a transaction, playing both the buyer and the seller, they can set whatever price they want. They essentially created a perfectly circular mechanism to siphon money. The SEBI interim order from April 2025 detailed exactly how this worked. It alleged that over 262 crore of loan funds raised by Gensol for EV purchases had been diverted. The money didn't go to cars. 41 crore went straight into the personal accounts of the promoters, routed to buy luxury apartments.
Wow. And let me guess, the financial math was actually screaming danger the whole time, but the green EV story drowned it out.
Absolutely. Gensol's debt-to-equity ratio violently expanded from 1.5 times to over 3 times in just 2 years. Their debt was growing far faster than the operational cash flow from those car leases could actually support.
Yikes.
They were drowning in debt to keep the loop going. But the market completely missed it because the story of decarbonization was just too good to question.
So up to this point, we've been focusing heavily on the villains of the story. The massive frauds, the shadow loan books, the extraction loops. But what does a genuinely good balance sheet actually look like? If we're looking for character, how does integrity show up in the math?
It's a great question. And honestly, the answer is surprisingly dull. When you're dealing with genuine integrity, it looks like a total absence of complexity. It's incredibly boring consistency.
Okay, let's unpack boring consistency. Give me an example of a promoter who actually does this right.
Look at Narayana Murthy running Infosys from 1993 to 2011. That era is the absolute gold standard. His compensation remained completely modest relative to the scale of the company. Related party transactions were practically non-existent.
Meaning he wasn't secretly buying software from his brother-in-law's consulting firm?
Exactly. The structure is completely flat and transparent, and they didn't chase flashy empire-building acquisitions just to make the revenue look bigger on a spreadsheet. They consistently returned cash to shareholders through dividends.
That is rare.
It is, but the biggest tell was their accounting standards. Infosys voluntarily adopted strict U.S. GAAP reporting standards years before Indian regulators forced anyone to do so.
Wait, why does that matter? Why volunteer for stricter rules?
Because U.S. GAAP, generally accepted accounting principles, requires far more aggressive disclosure of potential risks and off-balance sheet items. By voluntarily subjecting themselves to a harsher grading curve, they were signaling character. They were essentially saying, we have nothing to hide.
That's a huge flex, honestly.
Right. And there was zero share pledging, no private corporate jets quietly written off as travel expenses. It was pristine.
So integrity is essentially a clean holding structure. No weird layers, no shell companies separating the promoter from the actual business.
Precisely. Radhaki Chandamani with DMart is another perfect example. The article describes their capital allocation discipline as monastic.
Monastic, I love that.
Yeah, they carry zero debt beyond working capital, meaning they only borrow what they absolutely need for day-to-day operations, like buying inventory.
But what about expanding? Retailers usually borrow heavily to open new stores.
Not DMart. Every new store expansion is funded entirely from internal accruals.
Meaning they only use the cash they actually made from selling groceries, not cash they borrowed from a bank.
Exactly. And the reason this protects you as an investor is structural. By funding expansion only with cash you generate, you completely remove the risk of a debt spiral. If a bad year hits, or the economy tanks, they don't face bankruptcy or margin calls. They just pause opening new stores.
Simple.
Yes. Damani also takes a negligible compensation package compared to the value of his equity. His interests are structurally aligned with the minority shareholder because he creates wealth by holding equity right alongside you, not by bleeding the company through massive salaries or shady consulting fees.
I have to point out, though, that boring doesn't make for good news cycles. A CEO who says, well, we had a tough year, so we didn't open any new stores and we didn't buy a corporate jet, isn't getting invited to speak at Davos.
Right.
Which is exactly why you as an investor or analyst have to actively seek out these quiet, consistent signals over hyped-up narratives.
That is the crucial takeaway. If a company's annual report sounds exactly the same during a brutal recessionary year as it does in a boom year, that is a massive signal of integrity. Promoters who constantly reshape their narrative or, redefine metrics to invent things like community-adjusted EBITDA. Just because the stock price took a hit, they are performing for you. They aren't reporting to you.
So what does this all mean? How can someone listening actually operationalize this knowledge? We know that rigid checklists can create a false sense of security, so what's the alternative framework?
This raises an important question about how we build a diagnostic mosaic of a leader. You can't rely on one metric. You have to look for patterns. The article lays out several key tests. First, look at capital allocation under zero pressure.
Okay.
What does the promoter do with excess cash when times are roaring? Do they conservatively buy back stock or issue dividends? Or do they immediately diversify into massive, unrelated vanity projects just because they have the cash?
Right. How they act when they have too much money reveals their true discipline. What else goes into this mosaic?
Watch their pledging trajectory. Pledging shares means the promoter is using their stock as collateral to get a personal loan from a bank. It isn't necessarily bad in small doses, but direction matters. How so? If they're constantly increasing their pledges, crossing 50% of their holdings, they are using the market's confidence as a personal credit line. And if the stock price drops, the bank issues a margin call, forcing them to sell the stock, which crashes the price further. You are one margin call away from disaster.
That makes perfect sense. What about the related party transactions, like the Gensol example we talked about earlier?
Do a related party audit. Don't just look at the size of the transactions, look at the nature of them. Vague consulting fees paid to a family office. Random brand usage fees paid to the founder's wife. You have to ask what I call the employee test.
The employee test.
Yeah, would this transaction exist if they weren't the promoter?
Oh, that's brilliant. If a middle manager tried to expense a vague consulting fee to his brother's firm, he'd be fired. But when the CEO does it, we call it a synergy.
Exactly. Next, look at their management commentary and compensation. If promoter compensation has compounded at 25% annually over a decade, while minority shareholder returns are stuck at 8%, you don't own a growing business. You own a value extraction machine.
Yep.
And finally, watch the auditors. 2 auditor changes in 5 years or a midterm resignation is a flashing red light. An auditor resigning midterm means they saw something in the books that made them completely unwilling to risk their own legal liability to sign off on it.
Okay, I have to jump in here because my absolute favorite diagnostic tool from the article is what they call the Sunday morning test. It's brilliant. Let me spell this out for you listening. Forget the spreadsheets, forget the multiples. Ask yourself this. If this specific founder called you on a Sunday morning and asked you to wire them money for an urgent opportunity with minimal documentation, would you do it?
It's the ultimate distillation of character.
Exactly. Because if your gut reaction is, absolutely not, I don't trust this guy with my wallet, then why on earth are you perfectly comfortable buying their stock on a Monday morning? It's like lending your car to a friend who you know is chronically irresponsible, but somehow thinking that because there's a formal brokerage contract, they won't crash it.
It perfectly captures the essence of the entire problem. We use the stock exchange, the complex brokerage apps, and all the financial jargon as a shield to pretend we aren't just handing our hard-earned money over to another flawed human being.
So let's bring it all together. The ultimate takeaway from today's deep dive is that every single financial assumption you make, whether it's a deeply complex discounted cash flow model or a simple revenue multiple, is actually a character assumption. You cannot rely on the numbers unless you can rely on the person who generated them.
That's the bottom line.
Digging into the human being running the show, looking at their history and their integrity, isn't some soft skill you bolt onto the end of your analysis. It is the actual analysis. Everything else is just arithmetic.
And, if we connect this to the bigger picture of where the world is heading, it leaves us with a fascinating, almost philosophical challenge.
What's that?
Well, in an era where we increasingly rely on artificial intelligence and algorithmic trading to make our financial decisions, how will machines ever learn to evaluate human character? Can an algorithm ever be taught to apply the Sunday morning test? Or will human integrity remain the one absolute, unquantifiable edge that a human analyst has over the machine?
That is a phenomenal question to chew on. As you go back out there and look at the businesses, the teams, or the projects you invest your time and money into, remember to look past the beautiful blueprint. Look at the chef in the kitchen. Make sure they aren't going to poison the meal. Thank you so much for joining us on this deep dive. Keep asking the hard questions, and we'll catch you next time.